The real economy is broken because of the printing of money, that it distorts the actual operation of money, the function of money, the price signals of money. Your money is losing its value. The printing of money is the problem. Bitcoin is money that can't be printed. It's the solution for that problem, and it's expressly built to solve it. Its fixed supply is the source of all fundamental value in Bitcoin. There will only ever be 21 million Bitcoin. It's volatile for the reason that it has a fixed supply and that everyone's adopting Bitcoin for the first time. It's naturally volatile. It's necessarily volatile.
So the volatility is there, the price of Bitcoin going up and down. I think that's a good thing. But in regards to like being a stable medium exchange today, maybe it's not. So how do we think about the volatility, as you said, in regards to payments today versus like an evolution of that?
Great question. So
Parker, you said that Bitcoin is the most important innovation in the world. Why should someone listening to start this out, maybe skeptical on the fence, why should they right now be dropping everything and paying attention to Bitcoin?
I think oftentimes people look at Bitcoin as a solution in search of a problem. And that the reality of the situation is that people do not understand the problem that they have. They might know that they have problems, but they might not know the root cause of it or the source of it. And that, in my view, the most pressing problem that everyone is suffering is that their money is constantly being debased, and that Bitcoin is the solution to that problem, and that they're seeking out somewhere on the range of imperfect solutions to bad solutions for the problem because they misunderstand it. And that Bitcoin solves the most important problem for the greatest number of people on earth, and it's still very early and not well understood. And that once they figure out Bitcoin, and they can also most efficiently go down that rabbit hole, because it might be complicated, it might be unintuitive at first, but it's a finite surface area, and all of the other derivative problems that they might perceive in their life stem from, in most circumstances, maybe not all circumstances, but in most circumstances, at least from a financial perspective, because their money is constantly losing value. And so all the time and energy they're putting into to accumulate money or to acquire money to pay for various things in their life is being destroyed, and Bitcoin fixes that.
The biggest problem in the world it fixes. And so when you solve a big problem for a lot of people, there's a lot of value created. Let's just push on that for a second, because what you're saying is it solves the biggest problem for the most people, which is their money is losing value, so they have to work harder and harder to maintain their life. But do you think most people, when we talk broadly, the masses, understand that? Like, do they see that as a problem?
They see it as a problem, but they don't understand the extent of it. I'd say most people are engineered to know that their money loses value, so they try to address it on the margin. They invest in the equity markets to offset inflation, or they invest in real estate passively to offset the problem. And one of the things I like to say is like, hey, if there's a business that needs to be funded that is going to deliver a lot of value in the world, those businesses still need to be funded. If you dig up dirt and build a piece of real estate that delivers value, like that is a necessary piece of the equation, because ultimately money is helping to facilitate exchange and to deliver real goods and services to the world, which is really what improves people's lives. But in the circumstance where people know that their money loses value, but not knowing why, or that it ends a lot worse than they think, that it's not just their money losing 2% a year, or 3% or 5%, that ultimately it stops working. And there's plenty of historical evidence, and there's also a fundamental underpinning it that humans can't work and convert their time and energy into something that can be easily produced. Money being created out of thin air, that it's that they know there's a problem, they just don't know the root of it or the extent of it, or how negatively asymmetric the end consequence of money being debased really is.
I would just go a step further. I think most people see prices going up and things keep getting more expensive. And so if I don't invest, how will I buy them in the future? Which is the same thing as you're saying, but it's the opposite side, right? The money is being debased, it's losing value, which is why prices are going up. But they don't see the money being debased and going down. They just see the prices going up.
Yeah, Saif Moose, the author of the Bitcoin Standard, has a great quote that I consistently see circulating where you're saying the groceries aren't getting more expensive, your money's losing its value.
Right.
And it's the other side of the same coin, but it's a really important framing to shift your perspective
Yeah.
and your understanding of the root problem.
Right. And we saw in the last election that we just had where Trump won, and inflation was probably one of the hottest subjects going. But people aren't really understanding the root cause of this inflation, or as they see CPI going up. And so, yeah, so not understanding the problem at hand, that's the number one obstacle to Bitcoin. They think of it as a solution looking for a problem because they don't realize the problem is that the reason why your life keeps getting more expensive is that your money is losing value.
Or connecting it to Bitcoin, that Bitcoin's the solution to that.
Right. Yeah. Got it. So, you used to write a lot. You've still been writing some stuff. I want to talk about some of the stuff you've written, but the big one is the gradually then suddenly, which is amazing. And you sort of took like a first principles approach to sort of explaining Bitcoin. How would you put that into maybe like a 3-step framework for people to like think about and then maybe go dig into and research more from there?
Yeah, so the 3 things are the problem that Bitcoin's actually solving, that is not a solution in search of a problem, that it's an express solution to an express problem, and the problem is printing of money. So
start there.
You have a problem. One of the things that you just mentioned is in the last election, at least in the United States, inflation was a big focus area. I never saw one politician who was talking about it on the stump, connecting it to the printing of money.
Right.
The printing of money is the source of that. You have a problem. The printing of money is the problem. Bitcoin is money that can't be printed. It's the solution for that problem, and it's expressly built to solve it.
Right.
So connecting it to the problem is one framework. The second framework is understanding Bitcoin from a bottom-up perspective as to why it actually solves the problem and how. And the quick high level of that is that its fixed supply is the source of all fundamental value in Bitcoin. There will only ever be 21 million Bitcoin.
Right.
What it represents is money that can't be printed, and that how Bitcoin is able to enforce its fixed supply is of significant consequence to the equation. That it is not random, it's not by happenstance, it might be complicated or complex. There's a lot underneath the hood, but you first have to understand why it's relevant, why a form of money that can't be printed would be relevant to somebody to then be able to go down and connect the dots as to how the economic incentives are able to be held together such that Bitcoin can credibly enforce its fixed supply without the need for trust. So that's the second thing. And then the third framework is all the common misconceptions about Bitcoin, which are that it's too volatile to be money, or that it can be easily copied, or that it's just for criminals, which just for criminals is becoming less of a knock on Bitcoin as governments around the world and corporations around the world are adopting it as money. It's becoming more difficult for somebody to posit that, but basically understanding things that are difficult to see. If you could say, hey, it would make sense that if there were a form of money that can't be printed, that everyone would adopt it.
Yeah.
But how does that marry with the fact that Bitcoin goes up 10% in a day or down? That's not how I have known, or, I say I, but the person that's evaluating it might look and say, well, Bitcoin can't be money for that reason. And in reality, if you realize that it's volatile for the reason that it has a fixed supply and that everyone's adopting Bitcoin for the first time, it's naturally volatile. It's necessarily volatile. So people have to work through those mental blocks in order to come back to the highest level ideas behind Bitcoin to see how they're consistent with each other and not inconsistent. So the problem, the fundamentals, the bottom up, and then the common questions that are logical to ask but have coherent, consistent explanations.
So let's dig into the volatility and why it can't be money. So obviously with you work on Bitcoin payments, that's sort of your life right now with Zaprite. So I want to dig into that. I want to talk about stablecoins and the Genius Act and maybe how that complements or doesn't complement Bitcoin. But let's just talk about the payments piece overall, and we'll talk about those things. So the volatility is there. The price of Bitcoin going up and down. I think that's a good thing. But in regards to like being a stable medium exchange today, maybe it's not. So there's today and there's a future. So like, will it ever be versus is it the best today? So how do we think through that? Because if I want to, if I'm in a country with a failing currency and I could maybe go to the dollar, or I could go to Bitcoin, but I don't have that much money. And if I go to buy groceries next week, but I can't buy as much, that could be a problem. So how do we think about the volatility, as you said, in regards to payments today versus like an evolution of that?
Great question. So, one, I think that to start, you have to understand why Bitcoin's volatile. You have to understand why it's volatile and why volatility is not a risk. And when I say that, it's that volatility can be a risk depending on what your time horizon is.
Right.
And so you have to be able to explain to yourself first why Bitcoin would store value over time despite being volatile, that its volatility is actually to your benefit. That, one way I would think about it is if only 1% of the world has any material exposure to Bitcoin, and if you marry that with this idea that everyone in the world, if they understood that there were a form of money that can't be printed and that Bitcoin is that, and that its fixed supply of 21 million is credible, that 99% of the world is yet to adopt it.
Right.
But they would adopt it for the very same reason that someone would, who's already adopted it, understood that it holds value because more of it can't be created, but it's also necessarily volatile. If 1% of the world has figured this out, well, if 10% were to figure it out, then that means that 9 out of every 10 people in the world that are buying Bitcoin for the first time, or pricing Bitcoin, or are putting a value on it for the first time in their life.
Right.
Well, if more can't be created, there has to be price discovery.
Right.
That price discovery is naturally volatile, but the volatility for people who already hold it is a benefit, because if 10 times the number of people are demanding an asset, even if they're pricing it for the first time, are having to bid the price up to deliver value to people that already do hold it, again, that is in your benefit. So first, you have to anchor to that fundamental that is volatile for the very same reason of why someone would demand it in the first place, and that is connected to its ability to store value.
Let me hit on that. So because it's a fixed supply and we have more people coming in and maybe some going out, I mean, there's ebb and flow a little bit. So we get price moving up and down, price volatility because of that. Now, if we look at the long lens of Bitcoin, the price volatility moves to the upside. And so as an investor, we want the price to go up, right? We don't want to be in a stablecoin that never moves. And so that volatility is our advantage. It's a necessary good, I think is the point that you're making.
Yes.
Right? So it's volatile, but volatile to the upside. We like that. But depends on the duration.
Correct. So then the way that I would think about that is, and it is this difficult problem. If you have no savings and you are barely saving more than, like when I say no savings, you have no
paycheck to paycheck.
Yeah, if you're paycheck to paycheck and Bitcoin is volatile, then you still have to figure out how to get savings. And the form of money that can't be printed is going to store your value best over time, but you have to get to that point in time. And so it becomes the identical equation of saying, like, okay, I first have to produce more than I consume. And then I have to start saving a small percentage in Bitcoin such that as it's volatile, it doesn't put me back in that negative position of being paycheck to paycheck. Okay. So another way to say it is someone that has a lot of savings can more easily adopt Bitcoin than someone that has no savings at all.
Of course.
But everyone has to accumulate savings to get out of that rat race, to get out of living paycheck to paycheck. So it becomes a world to say, well, hey, maybe you need to have enough dollars or a stable coin that might be losing its value slowly, but is maintaining its value day to day better, saying, I need to cover myself for a month or 2 months or 3 months to have that security.
A buffer.
But then saying, well, anything that is more than 3 months, I need to be exposed to the asset that stores value over time. And so it's marrying the short-term needs with the long-term benefits.
Okay.
And such that someone that has no savings, realistically, like they still need to be saving in Bitcoin, but they might be able to have a smaller percentage because their personal working capital is non-existent and they need to build that up. And so they still have the problem and there's no easy way out of it. But it becomes a function of each month saving more than you spend,
Right.
and putting a small amount away. But now somebody that has a lot of savings that doesn't have, a working capital need of 6 months or a year, that then they start looking at the equation and saying, hey, if I have this in cash in a form of money that loses value, that's engineered to lose value, I need to be thinking longer than just a month or 2 months or 3 months. I need to be thinking about a year or 10 years. And the more that you can save in an asset that's volatile, but stores value better than anything else for very logical reasons, that everyone needs money, everyone needs sound money, and people are adopting Bitcoin for that reason, then it becomes a kind of time horizon and managing short-term volatility for the benefit of long-term purchasing power.
Yeah. So to summarize that, then we have to understand that both dollars and Bitcoin are both volatile. Price moves, but Bitcoin is more volatile to the upside, whereas the dollar is just always constantly volatile to the downside.
Right. And
so we want to look at those over different time horizons, where think of it as a checking and a savings and a little bit. And depending on my time horizons and the amount of money that I make, then I want to be storing in the more volatile asset because it holds value better over longer periods of time. But I might be willing to put a little bit into the less volatile asset that holds value better in a short period of time.
Right. Yeah, correct. And so, I always try to use it to a tangible example. It's like, hey, if I need to go buy beef at the grocery store tomorrow or over the next week, and there's a possibility that Bitcoin drops by 10% and I can't then go buy the amount of beef that I need, I haven't solved my problem. But if I know that the price of beef, looking at ground beef, if it goes from $6 a pound to $10 a pound to $15 a pound, that I need beef in 6 months too. And if I'm just saving in this form of money that is the other side of that same coin, which we discussed before, of like your groceries aren't getting more expensive, your money is losing value. That you need beef next week, but you also need beef in 6 months.
Right.
If you do the same thing for the next week that you're trying to solve for in 6 months or a year, you're going to end up in a far worse place.
Yeah. Because the dollar might buy you more beef next week, but it's most likely guaranteed to buy you less beef in a year.
Yeah.
Let's talk about the dollar, but more specifically stablecoins. So sort of maybe somewhat historic here in the United States. We just passed this Genius Act, the Stablecoin Act. Scott Bessent, the head of the Treasury, whose job is to sell U.S. debt, right? That's his primary job, sell the treasuries. He seemed to be pushing towards these stablecoins. He said that he sees stablecoins growing by 3.7 trillion by 2030. I saw you were talking about the difference of dollars in that, but I think I saw you make a tweet something about it being like regulatory capture.
Yeah. So, if you play it out, again, this is, balancing short term with long term, that the short term benefit is that there's a positive regulatory stance towards the digital currency world, which it is, and we can say that that's, I won't say it's undeniable, but it's close to undeniable. It's like, hey,
that there's a regulatory stance to
that's positive, that's welcoming to this
in the U.S. right now.
Yeah. And that's better than if Elizabeth Warren was going out trying to whack-a-mole everybody working on Bitcoin or the broader, what people refer to as the crypto space.
Right.
That you want that it's better to have a regulatory apparatus that is friend, not foe. But long term, if you think about stable coins that are backed by dollars, it's not actually solving a problem, and that the very same interests that are helping to instantiate stable coins do not have an interest in private versions of the dollar existing long term. They get immense control and power out of having a digital version of the dollar that's controlled by the Fed. And that the larger that a stable coin grows, the more control that the the Fed and the Treasury or the office of the presidency would want to have over it, right? It becomes unavoidable, genuinely. And so that in my view, the large interests that were pushing the Stablecoin Act were special interests that wanted their stablecoin to be able to be the winner because they have seigniorage and they will extract value out of that. And so in the short term, it can feel like a positive because there's, when I'm thinking from a Bitcoin lens, that there are advocates that are friendly to an adjacent industry, not Bitcoin specifically,
Yeah.
and that there might be short-term benefits that come from that, and it would be certainly better than an active foe trying to go stamp out Bitcoin companies.
Yeah.
But the larger that a stablecoin grows, the more control the existing state apparatus is going to naturally have over it, and the interests of companies like Coinbase and USDC or anyone that interacts and helps move that stablecoin is going to be to use our stablecoin, not that stablecoin. And that's ultimately the root of, Tether has worked perfectly well all over the world without this. Why does it need this? The only reason it needs this is to ensure that the state apparatus doesn't come and shut it down. But then the other side of that coin is control. Why if the free market has been working, why not allow the free market to continue to work? The logical explanation of it is control, surveillance, and it might not play out in the next week or the next month, but that's the direction that it's heading. And in my view, like, we have serious problems. They need serious people to solve them. The fact that Bitcoin was de-emphasized for stablecoin legislation or market structure legislation, it just, to me, it points to regulatory capture versus innovation.
Yeah. Part of the Genius Act, there was a couple bills that went through. One was also called the Clarity Act. And that's how I felt about that bill specifically. Because, like, in America, we're the land of the free. We're supposed to be able to do whatever we want. And then laws are meant to tell us what we can't do. But here they're passing a Clarity Act to give us clarity on what we can do, which I thought was kind of weird. So I see that going that way. But let's just kind of go back to what you're saying here. So it seems like, well, number one, the government's not a monolith, right? So there's like multiple factions that have different interests that they want to see. I think both Trump and Besant want to see the dollar maintain some power around the world. 60% of FX transactions or something like that. Right now, we just dropped down to 59%. Besant wants to sell treasuries. Who's going to buy the treasuries? And so by getting people around the world to use dollar stablecoins, it sort of keeps the dollar's sort of demand. And then for the regulatory part, then we make those stablecoin companies buy U.S. treasuries. And then sort of de facto, you get people around the world to buy U.S. treasuries. I mean, would you say that seems to be what's at play here?
I think that's the line of thinking that's a first derivative that sounds good, sounds right, sounds plausible, and so people run with it. They say, hey, these stable coins are great for the US dollar. Safety Moose, again, he gave a great presentation at the Bitcoin conference where he basically explained that it's substitute demand. It's not creating demand for the treasuries. Somebody has to own all treasuries at all times.
Right.
If you think about what's actually happening in the financial system, if somebody is choosing to convert a deposit at a US bank to a dollar stablecoin, somewhere in the background, a reserve at the Fed is changing from one account to the other.
Sure.
And that somebody was holding a treasury and now somebody else is holding the treasury.
Yeah, but is it the government holding it? They had to print the money on buy on their own, or is it someone in Argentina or Venezuela?
Right, but if somebody, imagine the scenario where there's a central bank in Africa, and the person in Africa says, I want to hold a US dollar stablecoin. Well, the dollar doesn't just disappear. So the central bank in Africa might have bought a treasury. Now the private company that issued the stablecoin is buying the treasury. The treasury changed hand. It didn't create demand for the US treasury. And so I think that realistically what it more so is it's a new rail to move dollars. I think about it more as a method of payment. It genuinely does not create demand. Like as an example, BlackRock is the largest holder, I think. If it's not the largest holder, it's one of the top 2 or 3 holders of US treasuries. If their assets shift to some other party, and say it's a party that wants to hold stablecoins, it's like somebody is banking BlackRock, somebody's banking the stablecoin. That's the foundation. It's like the stablecoin is not creating demand, it's shifting demand.
It's shifting demand, but I want to. We'll get into sort of the failing system that we have in a little bit, but just to talk about this for a second, if there's a massive demand, external demand for U.S. treasuries, it's easier for the U.S. to sell the treasuries into the market and manage the debt. Whereas if the government has to, as we've seen many times other countries around the world, have to print money to buy their own debt,
right,
it goes into a deep, a pretty fast doom loop, right?
Right.
So if we have to print money to buy our own debt, that's a problem. Versus if there's a massive demand externally for our debt, then it's not as bad. And so I would say, to the point that you're making, yes, the Treasury has to, whatever debt they need to send out, they need to send out. So there's the demand. But as far as shifting the demand, if they have to print and buy it themselves, it's much worse than if some bank in, I think you said Zimbabwe or Africa, buys it.
Right. What I'm saying is we all have to accept that the only way that 36 trillion or 37 trillion of debt is getting repaid is because the Fed's going to create more of it.
Sure.
Everything else is moving chairs around on the deck.
Yeah.
Because 2 things are categorically true. The Treasury sets the number of treasuries that exist, and Congress, based on the amount that they spend versus the amount that they take in, is in relation to that.
Right.
But the
Treasury
Treasury
is the budget. They got to send
the
out
budget. The budget. So if the report that came out the other day is that just in the next 2 quarters, the Treasury is going to have to issue net incremental treasuries of 1.6 trillion.
Yeah.
1
right? Trillion.
The debt of the United States is growing by 1.6 trillion over the next
2 quarters.
2 quarters. That's the Treasury and Congress. The Fed is the single entity that sets the number of dollars that exist in the system. If the Fed is not increasing the number of dollars that exist in the system, and the Treasury is having to increase the supply of treasuries by 1.6 trillion, it's having to take out money from somewhere else in the system to replace that demand, right? So,
well,
as more treasuries exist, if the amount of dollars didn't increase, it's sucking money either out of the private sector or out of some other public sector need for money. And the only way it gets solved, the only way the leaky ship gets solved, is the Fed creating more dollars. That's why Trump's going to the Fed and saying, you got to increase the interest rate by 3%. Well, the only way to lower interest rates in terms of the real interest rate is printing money.
Right.
So more dollars have to exist to release the pressure of the market rate to borrow.
But does the Fed have to create the dollars?
Yes.
Because the euro dollar market is dollars increasing without the Fed doing anything.
Well, the same dilemma exists on the euro side. Like the European Central Bank ultimately has to create more euros to satisfy euro-denominated debt.
I'm talking about euro dollars.
Well, the euro dollars is the intersection of that, but the dollars need to be supplied. I don't say need to be, but the way that the current market is structured is that ultimately more dollars need to support more dollar-denominated debt. You can, again, like if the Fed isn't creating any more money, the Treasury is issuing 1.6 trillion. There are 1.6 trillion more deposits, credit, claims on dollars that exist out there without the Fed creating more money. My point is that the market figures out that the actual funding currency is becoming more scarce to the amount of claims on it.
Yeah.
That causes interest rates to rise.
Right.
The only way to actually solve that is the Fed singularly sets the number of dollars that exist in the system, the dollars that can move from bank to bank.
So the $0 market can't create those unilaterally.
They can create more claims on the base money.
Right.
But they can't create more of the base money.
Right. What about if billions of dollars of Argentine pesos convert into US dollars?
Again, there's a relationship between the actual number of pesos that exist in the world that are created by their central bank, and there are the number of dollars that exist created by our central bank, and then there are claims on those dollars. So it's like, yes, if somebody wanted to convert pesos to dollars, creates demand for dollars, creates lack of demand for pesos, which dictates that the peso issuer needs to issue more pesos or their system collapses.
Right. So it's robbing Peter to pay Paul. It's shuffling cards on the deck, but what it's doing
but the foundation of it that dictates all of it is the central issuer.
Right. And
if you are creating more debt on top of the existing money supply, ultimately people figure out that there aren't enough chairs on the deck, and they start all going to sit down at the same time to get the dollars that they need or the pesos that they need. That causes a credit collapse, that causes interest rates to rise, that induces the acceleration of money printing.
Right.
There's no way around it.
Right. There's no way around it. It's inevitable. How that looks and the time frame of those things vary based off of how good they can shuffle cards around the deck.
Yeah.
So the milkshake theory from Brent Johnson is that it puts a lot of pressure on the Argentine peso. They collapse, and then the dollar kind of just keeps sucking more and more, and things keep collapsing faster and faster and faster.
Right. So one system could collapse faster than another system.
Right.
But again, if the Treasury is issuing 1.6, like using the microcosm of the example, that's a real example based on their own estimates. If they're issuing 1.6 trillion more in dollar-denominated debt, that is more. And if the Fed is not increasing the money supply, that is more claims on the same amount of dollars that forces the dollar interest rate higher.
Right. Yeah.
So it's like, yes, the dollar milkshake theory can be accurate in that the peso could collapse faster than the dollar, but the same dynamic exists in the dollar. It's just
a function of the system.
It's collapsing slower. It's not collapsing.
Sure. It's a function of the system.
Yeah, and then ultimately Bitcoin becomes the release valve because as the market figures out, okay, well, the Treasury had to issue 1.6 trillion more dollars. That's more claims on dollars competing with the same amount of dollars. The only way to satisfy that demand is to force interest rates higher. Oh, well, now the Fed steps in and prints more dollars. Yeah. Shit. There is no rate of interest I can get on a dollar-denominated claim that performs better than just holding the form of money that is agnostic to this whole charade.
Yeah.
And so to come back to this idea that stablecoins create demand for dollars, no. They just shift from one party, and one party might be more inclined to buy U.S. Treasuries over some other instrument in the U.S. financial system, depending on, it moving out of one bank holding reserves to another. But it's all like you miss the forest for the trees if you don't realize that all of that is just deck chairs shifting. Yeah. And what really matters is the total amount of system debt that isn't just the U.S. Treasury. It's every private issuer of credit, every state, local, municipality issuing debt, the relationship of the total debt stack to the actual number of dollars that are in the system that can support it. Because what happens is, for intermittent periods of time, is that debt expands significantly without the actual number of dollars increasing to support it. The market figures it out. There becomes a credit collapse. They print more money.
Right.
2008-9, 2020, guaranteed to happen again.
Yeah.
And the only true exit valve from that is to get in the money that is not subject, that
To that.
is entirely divorced
Yeah.
from the function of credit.
Get off the deck where they're shuffling chairs and onto something else. So let's talk about the relief valve. So Howard Lutnick, Secretary of Commerce, before he came into the Trump administration, through his fund, Cantor Fitzgerald, was jumped into Bitcoin big time, right? $2 billion credit line, major stakes in MicroStrategy, major stakes in Tether. Now with the Trump administration building a Bitcoin reserve, maybe the sovereign wealth fund. His son now is deploying billions of dollars into Bitcoin companies. Trump himself just bought $2 billion, not himself, but through his company, which he owns controlling interest of, bought $2 billion worth of Bitcoin a week or two ago. Trump seems to have a way of maybe front running the markets and even telegraphing what's coming. He said you might want to buy stocks right before the tariff deal was announced. I think there could be a case where the government wants Bitcoin and gold maybe to run really hot. So we saw Elon Musk leave Doge. We can't cut. It's never going to work. We have to grow our way out of it. Scott Bessent goes on the TV saying we have to grow our way out of it. So we need to let inflation run hot. Hopefully GDP goes up faster than the debt. Maybe stablecoins can fuel some of that by maybe getting some money directly to the market, maybe get more inflation going. We have to grow our way out of it. But the problem is if we have a lot of inflation, prices going up too fast, people get unhappy. But Bitcoin is this liquidity sponge that is much more sensitive to liquidity than other assets. And so potentially if gold and Bitcoin could absorb a big piece of that liquidity and go up maybe faster and higher than most people think, it could keep the other assets and prices down a little bit. What do you think about that?
I think that it's, again, one of those things that can sound right in terms of a first derivative that fails to see the forest for the trees and is not functionally possible.
Okay.
And that this idea that you have to grow your way out of the debt. It's like, first you have to accept that the US credit system has grown faster than, even if GDP is a terrible metric to measure economic activity, the debt system has grown faster than GDP for the last 30 years.
Yeah.
And you're basically saying, okay, well, that has to reverse. But what if there's a relationship that dictates, given the level of debt, that it's not possible? So my point is that there's an amount of debt that exists in the world, and there's an amount of dollars that exists in the world. And to anchor people into what that general relationship is,
like 3 or 4 to 1?
No, it's like $102 trillion of dollar-denominated debt
to 350 trillion. Oh.
To about $6 to $7 trillion.
Oh.
And there is a mathematical equation. Now, not all of that $102 trillion of debt that's owed is due in a month, or due in 2 months, or a year, or 5 years. Some's not due for 30 years. But there's a mathematical relationship between $102 trillion of debt to $6 to $7 trillion that actually exists in the system.
Okay.
And that the $102 trillion of debt cannot be satisfied by the $6 to $7 trillion. Right. So the idea of, like, you know, if you were to relate this to the idea of GDP, like we have to grow our way out. How do you grow your way out if you didn't increase the number of dollars?
Yeah.
How do you grow out of the one?
Well, you don't grow your way out, but could we go from 110% debt to GDP to 80% debt to GDP? Change the ratio.
Well, we'll set aside debt to GDP for a second. The real of consequence ratio is the amount of debt that exists to the amount of dollars. How do we deleverage that system? There's 2 ways. There's allow the debt to reduce, or there's create more dollars. There's no other mathematical way, right? Now, the way that debt is reduced is that as debts become due, they get repaid and more credit's not issued.
Right.
The problem is that because of the extent of the leverage, that as soon as that credit system, so if that credit system that was 102 trillion went to 100 trillion to 98, forces interest rates higher. Okay. And basically the market, because the money because those are dollars that are in somebody's, say, account that are no longer there. People are tight.
Right.
So like the economy starts to shrink.
Right.
Or first it starts to grow slower.
Yeah.
Like basically growth is tied to credit expansion.
Right.
If the credit expansion starts to slow or then decline, the absolute amount of leverage is so high, it starts to feed on itself.
Yeah.
One, credit contraction begets credit contraction, ultimately induces a credit collapse.
Yeah.
That induces the printing of more money. And so it's like you can't get yourself out of the mathematical equation. Like you could take a piece of debt that's sitting on a productive asset, say like an oil and gas well, and say, well, cancel the debt and now it has a new equity holder. It's just that we live in a world that's so leveraged that would create, and it ultimately will. There's, it's a catch-22. There's no way out of it. The way out of it is printing of money, or the more accelerated decline of the dollar via hyperinflation and a credit collapse. So, everything else of like GDP growth, it's like $102 trillion of debt, $6 to $7 trillion. The Fed sets the number of dollars that exist, and then the market creates credit on top of that. But every time since, realistically 2008-9, the market figured out that something was inherently broken. Not everyone knows the source of it, and guaranteed they print more money. And there's no chasing it. So and one thing last thing I want to say is, like, when people talk about GDP and outgrowing debt, if you lose sight of the real economy and what money is supposed to deliver to the economy, more goods and services, and just think in terms of GDP and GDP growth and relationship of how much more money needs to exist to satisfy it. It's like what is actually broken is the real economy, and the real economy is broken because of the printing of money. That it distorts the actual operation of money, the function of money, the price signals of money, and we're not going to get to a more stable world until the fly is taken out of the ointment. The ability to print money no longer exists because governments adopt Bitcoin and then they can't print money. Yeah. And they have to be honest in terms of how they finance their operations, because what happens as a natural consequence is that 1.6 trillion ultimately gets financed by the creation of more money. Right.
The inevitability of the system is we are on a debt-based monetary system, and because of that, the debt has to always grow, and because of that, we never pay the debt off. And so the inevitability of the system is eventually it ends.
And the real economy gets destroyed because of that.
And the real economy gets destroyed because of that. Now, we have a solution with Bitcoin that can allow people, businesses, individuals, businesses, nonprofits, churches, and corporations, and even governments start offloading onto another ship to maybe try to save itself from the inevitable collapse. I guess I was just thinking more in terms of shorter term moves.
Yeah.
The next 4 years of the Trump administration, we saw in the 80s, Israel was facing, triple digit debt to GDP ratios, let high double-digit inflation happened for 3 or 4 years, inflated the GDP, which changed the ratio down to 75%.
But the only way to do what they, I'm not an expert in that, but what I would presume is they printed more money to deleverage.
Sure. Yeah, and that's my point. So we're going to print a lot more money. Trump wants, as you said earlier, right? He wants Powell or the Fed to drop rates 3 points, down to 1.5. That's going to print a lot more money. Potentially, we can get there's $3.3 trillion of sterilized reserves sitting in the banks that they could issue stablecoins against and put that onto the street. That's more money, and so that's a lot of inflation.
Again, but yeah, it is.
It's a lot of inflation.
It's a lot of inflation, and again, I'm not an expert in the history of Weimar Germany, but I know some of the history, and there is this natural phenomenon that when the price of Bitcoin goes up, you think that you're getting richer. When the value of your stock market goes up, you think that you're getting richer.
Right.
But it misses what wealth is.
Yeah.
It misses that the your the day-to-day delivery of goods and services that you consume, and the increasing base of capital not in terms of dollars, but capital in terms of productive capacity, delivering real goods and services to the market.
Right.
That's wealth. That's the thing that
Sure.
improves the day-to-day living of more people.
Yep.
And that when, someone like Trump might buy Bitcoin and think that Bitcoin's helping the dollar, he might just not be seeing the forest for the trees, and that it might feel good to all of us when the dollar value of our Bitcoin goes up. But if more businesses are being destroyed than are being created, we're the boiling frog.
Right.
And so it's very easy for people to not realize, and I'm talking specifically about people that are putting forward legislation or regulations, or even Trump, buying Bitcoin and not seeing the end game, thinking like, oh, it's a good thing if, the stock market moves up. But like, think about the craziness of the stock market. I think, reached all-time highs, or the S&P at least, and like, it's at an all-time high. And Trump is sitting there telling the Fed chair that he's going to fire him to reduce interest rates by 3%.
Yeah.
Like, what good is your stock going up if the actual, fabric of the productive capacity of an economy being destroyed along with it?
Yeah. That is certainly correct. Most people, unfortunately, just don't see it. As we started at the beginning, is most people don't understand the problem. And so part of the CP lie is to get us confused on prices going up is inflation. And we don't understand why electronics went down and this went up, and we don't understand it's the money supply. I think the average American would much rather see their home value, their retirement accounts go up, even if gas went up a little bit, than to see all of their life savings get cut in half and gas stayed the same and went down a little bit.
Right. The problem is that they have to consume their house every day, and they have to consume gas. That they have to have both.
Yeah. And you've mentioned several times, like, thinking through first order derivatives. So if you think through second, third, fourth, fifth order, where does this go? And then what? You see the impending doom that it creates. But most people just unfortunately can't see that. Oh man. Hopefully he's not going to be there very long. Let me ask one more question, and then we'll probably wrap this up. So we've talked about the impending doom, the inevitability of the system. It was never going to work, right? It's a function of the way the system works. But maybe we're starting to see the world waking up to this reality. You mentioned earlier, you posted a chart of the gilt market in the UK is like plunging. And if we look at like the long bond around the world, they're all like basically making new all-time highs. And you mentioned it's like a regime change.
Yeah.
A regime change where maybe the entire world is starting to wake up and realize that the only way to pay those is printing lots of money and we have to go find something else? Or what was the regime change?
Yeah. So one way I think about this is that the academic economists, which make up the Federal Reserve or central banks all over the world, think about pulling levers or pulling, basically taking actions, expecting certain reactions. So traditionally, the world of academic economists that make up central banks think, well, if I increase interest rates, I'll decrease inflation. The person in the real economy realizes that if you arbitrarily increase interest rates, you're not going to make goods more abundant. You might destroy someone's ability to buy a good, but
right.
The real way to make goods cheaper is greater abundance. I say that to then bring up the point of, well, the consequence of raising interest rates, and let's talk about a real example of the Federal Reserve increasing interest rates aggressively in 2022. And we're sitting in 2025, that the other side of increasing interest rates is the value of the underlying bonds declining in value.
Right.
And that the past regime was low interest rates manipulated lower for a long period of time, and it trained this entire class of investor to say, well, the Fed's going to print money to get these bonds to zero. So even if it doesn't make sense to lend government or money to the government for a long period of time, say 10 years, 20 years, or 30 years at this arbitrarily low rate, I'm going to do it anyways because they're going to have to buy these assets to force the interest rates lower.
Right.
Well, by keeping interest rates higher for longer periods of time, there was massive amount of holders of those bonds that got burned.
Right.
That lost money doing the quote safe thing.
Right.
And it's a fool me once, shame on you, fool me twice, shame on me.
Right.
The market has learned that they cannot bet on the fact that the Fed's going to, even if the Fed is going to have to print money, the time duration matters. And they've lost, they've gotten burned. So you're not going to fool me again. And that when the Fed starts to lower interest rates by printing money, or the Bank of England or the European Central Bank, the holders of those assets are like, why would I do this again?
Right.
You've already tried to quote, reduce inflation by starving the market.
Right.
I got burned by that. So even if you try to force interest rates lower, I'm not buying your paper. You're going to have to buy your paper.
Right.
And so
that's the regime change.
That's the regime change, that the market has gotten burned and they're not going to be quick to become the boiling frog again.
Right.
To become the bag holder. So that it seems like, and not in terms of a truly dislocated way, but that central banks have lost control. That the market is the true setter of interest rate.
Right.
What the consequence is that central banks are going to have to be more aggressive in buying their own debt. The only way that they can do that is by printing more money. The operation by which central banks buy the debt of the government is creating more supply of the base money, increasing that 6 to 7 trillion to 8 trillion, 9 trillion, 10 trillion.
That's the Lynn Alden's "nothing stops this train."
Yeah, and the true thing that dictates that nothing stops the train is the relationship between the debt in the system to the actual number of base dollars or euros or yen. And at the level just below that is that if you have a form of money that is built foundationally with the idea that it can be created by a central issuer at no cost, that the market's going to figure that out.
Yeah.
And opt in to a different form of money that has a different set of rules, being Bitcoin.
All right, so we've talked about the inevitability of the system and where this is all going. And one part I didn't get a chance to hit on is you talked about the volatility of Bitcoin and starting to think about how we're allocating to it. So we see the inevitability, you've built that up nicely for us, and using maybe some dollars and Bitcoin. But I know you have a company, Zappright, and you're pioneering Bitcoin payments. And so I'm just curious what you see from that regard. I see this as like this evolutionary path. I know you're sort of bringing that forward. What have you seen since you've been working on payments? How has the adoption of that been going?
Well, I think one thing, because we talked about this previously, but then connecting it with this idea of why central banks are going to have to create more money, and it's this trade-off of short-term volatility versus long-term destruction of value. Both of those two things coexist with each other, and everyone within the system has to solve it. So a lot of people naturally look at Bitcoin's volatility and say, well, how could anybody ever accept it as payment? And it's a very logical dilemma looking at the surface level.
Yeah.
But in reality, it's the same dilemma of buying Bitcoin for dollars as accepting it for payment. That if you think about, one of the strategies that people employ in Bitcoin is dollar cost averaging, buying a small amount every day or every week, and they're taking a different price. They're buying $100 and the price of Bitcoin's X one day and lower the next day and higher the next day, and getting a little bit more Bitcoin one day and less Bitcoin.
Yeah.
That if somebody has figured out why, yes, Bitcoin is volatile, but why it stores value over time, that it's money that can't be printed, and they have a business, that they realize the end game and they say, well, if I start selling my goods and services for Bitcoin, yes, the price is different. I'm still, day to day, and I'm going to still be pricing goods or services in some dollar denomination, or if you're in Europe, euro denomination. But it's the same as dollar cost averaging, because when they turn on the ability to be paid in Bitcoin, 100% of their sales do not magically turn up in Bitcoin.
Right.
It might be 1% to 2% to 5% to 10%. And say that a business was doing 90% of their sales in fiat and 10% in Bitcoin. Well, they were going to have to convert that 10% of fiat into Bitcoin because they wanted to save in Bitcoin anyways.
Yeah.
And so it just is a different means to actually acquire the Bitcoin, but in a way that de-risks the business at the same time.
Yeah.
That is able to say, well, I can still be paid in dollars and I have my dollar rails, but now I have this new rail that creates redundancy and allows me to market my services, to appeal to people that have Bitcoin, and to actually make the transaction more efficient if people want to pay me in that way. And so we're still early to Bitcoin payments. So like the way I think about it is we're early to Bitcoin, which means that we're earlier to Bitcoin payments, because somebody does necessarily need to understand something fundamental about Bitcoin. Like I do not think, as an example, that somebody that does not know why Bitcoin stores value, even while it being volatile, should endeavor to accept Bitcoin payments.
Yeah.
It's a reverse order of operation. It's decidedly the wrong order. But if everyone is on this curve of understanding Bitcoin, understanding the problem that it solves, that the people that were earlier to understand Bitcoin are increasingly asking to be paid in Bitcoin. So we're seeing growing trends. There's a recognition that it's early to the ball game, but somebody has to be early.
Yeah.
And that the amount of adoption that we're seeing feels like, an inflection point doesn't mean the majority of the world in a year or two, not just accepting Bitcoin, but doing more than 50% of their sales, but that there's a critical mass that it's going to materially accelerate. Companies like Square turning on Bitcoin payments, in my mind, is a watershed moment for everybody working on Bitcoin payments, but also for everyone out there that's providing a payment service that doesn't have Bitcoin incorporated, because it becomes a differentiation for any platform.
And we've seen, the best case was at the Bitcoin conference like 2 months ago. Steak and Shake announced that they were going to start accepting Bitcoin. And I think it was the president maybe of Steak and Shake got up and gave a talk, and he gave some numbers out. I forget what it was, but they increased like per store visits like 50% or some crazy number. You may know that, but I mean, you can see that first mover advantage where all of a sudden people wanted to go spend the Bitcoin. And of course, as the wealth of Bitcoin continues to grow, people are going to want to spend it. So
yeah, and someone might say, well, why would somebody spend Bitcoin? If its value is going up so much. And it's not really a spending Bitcoin problem. It's a spending versus savings, because if you were going to spend your dollars, you could have decided not to consume and to buy the Bitcoin. And so
I love that framing. That's good.
Yeah, and so for a lot of people that have owned Bitcoin for a long time, the vast majority of their savings are in Bitcoin. Now that is, again, a small percentage of the population, but for those people, spending Bitcoin is actually easier than converting back into dollars and spending dollars. And if there's more people adopting Bitcoin, there's more people holding Bitcoin, and there's more merchants that want to accept it. And it's just this organic process of growth, and there will be accelerations of it and decelerations and accelerations again. But it ultimately needs to exist for Bitcoin to work long term. And that when I look out into the future, I think this shift to Bitcoin happens a lot faster than people think. And we're seeing the amount of volumes of people being interested in it. And the trend will only accelerate. And the Bitcoin payments might be a small segment of the economy, but it becomes a massive differentiator for platforms that have it versus those that don't. And what's becoming clear with an example of Steak and Shake is that Bitcoin is large enough that you can either service 100% of the economy, the fiat economy and the Bitcoin economy, or you can service a subset of it. And it still might be the majority of it, but you risk being at a disadvantage to one of your competitors that does accept it.
Right.
And that will be a force that also drives acceleration. That Bitcoin sales might be 1% or 2% or 5%, but if you don't have it, a large share of the economy, even if it's still small on a percentage basis, is going to shift somewhere else.
Yeah. Yeah. I love that. I love what you just said there, because it reframed my brain. It's not a spending Bitcoin, it's a spending question or thought, right? Where it's like, if I'm going to spend dollars, but those dollars go to buy Bitcoin.
Yeah.
So it's really a spending problem. And I hadn't really thought about that. That's a good reframe.
Yeah, and there's a thing that Jack Mallers talked about on a podcast that I think is really right, that like when you hold very few dollars, you think about it as opportunity cost in Bitcoin.
Right.
And when you hold a lot of dollars, you're just like, oh, I'll go spend my dollars on anything because they're losing value. And so it does as a consumption model. It shifts your framing of, do I really need this?
Yeah.
Am I willing to spend my Bitcoin on this?
Yeah.
And there's a lot of cases in my life, just because, the vast majority of all my savings are in Bitcoin, where it's a no-brainer. I need this.
Yeah.
I need to get the transmission of my car fixed. I need to spend this vacation money for my family.
Yeah.
And then there's other things where I'm like, do I really need that?
Yeah.
Do I need to go spend $500 on that dinner?
Yeah.
Or can I cook steaks at home and
Yeah.
enjoy the dinner more?
Yeah.
Not just because I'm saving, because I'm at home with my family rather than So it makes you essentially a better consumer. The more Bitcoin that you have and less fiat, because
a better capital allocator.
Yeah.
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 Cool. Let's wrap it up with that, Parker. Is there anything else that people should be paying attention to? I think you wrote a new piece recently, right? Bitcoin can't be copied.
No, someone just recirculated that. That was an older one, but no, my blog. I do write less. It's kind of like feeling that I only want to write when I have something that needs to be said. But I do post kind of from time to time on my blog. So gradually, then suddenly.xyz, my book. Yep. Which is on Saif Dean's website, The Safe House, spelled SAIF. So thesafehouse.com. They can get my book, Gradually Then Suddenly. Yep. And again, I say if you don't, people shouldn't just jump to Bitcoin payments. If they're still exploring why are people saying this thing Bitcoin's money? Why does it store value? Read a book. There's a number of other great books. Lynn Alden's books on the Safe House. Yeah. Saif Dean's books, but you can get my book there, Gradually Then Suddenly. So there would be where I point people. And if you're further down that path, you understand why Bitcoin stores value. You are a business owner. I would urge people who grok it to realize that accepting Bitcoin is just a more efficient way to acquire it. Yep. And it eliminates risk for your business at the same time. That if you're one of those people, check out our website, zapright.com. Yep. If you reach out to us, I'll likely be the person that's helping serve you day to day. So learn about it, inquire about it.
Perfect. Thanks. Let's wrap it up.